TED now applies another measure of liquidity known as cash ratio. The cash ratio compares the value of cash, bank balance and marketable securities with the current liabilities. The cash and bank balance plus marketable securities of Smart Fashions were €170,000 and the current liabilities as seen were €637,000. TED arrives at the cash ratio by dividing the cash and bank balance plus marketable securities with the current liabilities. In this way, the cash ratio of Smart Fashions comes to 0.27 times. TED finds that the standard cash ratio in the garment industry is 0.50 times. That is, one should have cash and cash equivalents to the extent of 50% of the current liabilities. The cash ratio of Smart Fashions is much lower than that of the industry standard. Let us see now how TED can improve the cash ratio of Smart Fashions. Do you remember that Smart Fashions had paid prepaid expenses of €30,000? Let us assume that if they had not paid this figure in advance, their cash balance would have been greater by €30,000, which would have been €130,000. Do you also recall that we had assumed that if Smart Fashions had invested €100,000 in marketable securities instead of a long-term investment, then the marketable securities would have been €170,000. Taking these two factors into consideration, the cash ratio can be improved. The improved cash ratio of Smart Fashions will be cash and bank balance plus marketable securities of €300,000 divided by current liabilities of €637,000. This gives a cash ratio of 0.47 times. The increase in cash balance and marketable securities would have improved the cash ratio from 0.27 times to 0.47 times. So, Smart Fashions can improve its cash ratio to 0.47 times by applying the factors seen. This will also bring the cash ratio of the company much closer to the industry standard of 0.50 times. Now you have studied the cash ratio and the various measures to improve the ratio.